Hello and good afternoon. I welcome you today to the Trading Spotlight webinar here with Admiral Markets on it's Friday, the 1st of May, 2020. Yeah, I'm happy to be here today and to present you a very interesting topic. In fact, it also is connected. It is also connected to a personal anecdote, which I will tell you within the next minutes then why this is in fact also very, very interesting topic for me. Yeah, short selling, how to trade even when prices drop. This is what we want to look at. To some of you, probably that's not so interesting, probably, because you might say, well, I'm trading CFDs. And for me, it's not a big topic, because if I want to short sell a stock, an index, if I want to short sell oil, if I want to short sell a currency pair, gold, whatever, I just click the sell button. But when trading physical stocks, then things are a little more complicated. And I think it's noteworthy, the differences between short selling physical stocks, whether it's possible or not. That's the big topic, in fact, and CFDs, and why, in fact, it is very, very interesting also to consider CFDs, opening an account with a CFD broker like Admiral Markets, once you're only probably a physical stock trader, but wondered how it is possible probably to profit also once prices drop, or not just that, but also to try to hedge your exposure when it comes to long-term portfolios, for example. So yeah, let's have a look at today's agenda. Question is, what is short selling? I will give you an introduction to that. It's also the question if everyone can short sell physical stocks. To give already a spoiler here, no, it's not. Then we also want to look at short selling with physical stocks versus CFDs. That's what I already said. And then there's also a topic then around advantages and risks in comparison between physical stocks and CFDs. Before we start, yeah, that's me. It's not necessary, in fact, to give an introduction to my person. If you're interested, then especially if you're watching this recording now on YouTube, then you find an interview I gave in July 2018, 19. I think it was 2019. I did this interview together with Admiral Markets, and there you can have a quite good introduction and an idea. Who am I? Where do I come from? What's my educational background? How did I start trading the markets? Yeah, in general about my person. So one thing which is probably noteworthy and which I generally use here to introduce Admiral Markets, the company, the broker behind this webinar series, is that I'm located in Berlin, in Germany. Why is this noteworthy? Because Admiral Markets is a global financial service provider, so with 20 offices and more around the globe, and one is in fact in Germany, in Berlin. So why is that of interest? Well, it's not necessarily because I have a personal relationship with the German team here, but it's very interesting. I mean, we're talking about financial services in general, and I'm in this industry now for, in fact, in the CFD-FX industry for more than 10 years. And I started out as an employee with a bank that was, oh my gosh, I'm so old right now. It's nearly 20 years ago, 15 years, more than 15 years. Gosh, I'm getting old, but yeah, however. What I can say is that it's a very, very sensitive topic. So when we talk about financial services, it's very, very sensitive. And what I can imagine, respectively, what I experienced during this time was that people usually were really happy to talk to someone in their native language once they had a question, once they had something to criticize, once they had, question digging deeper into whatever topic. And so when it comes to Admiral Markets, this is perfect, because there you have a broker who has offices around the globe. So it's very, very likely that we will find someone in talking or speaking your native language, and you can talk to in your native language then. And this is only one positive side note, but I think a personal one, which is noteworthy. It's beside that, it's also definitely worth giving Admiral a deeper look when you look at the offering in general. So for example, here in Germany, we refer to Admiral markets as the DAX expert. That's usually due to the fact that Admiral has, in my opinion, one of the most competitive offerings when it comes to DAX trading. But it's not only DAX related, and here with the 0.8 spread, for example, or in the Admiral Prime, Admiral Zero solution, there you have a 0.2 spread and pay a commission on top of that. But there's also a very, very competitive offering when it comes to FX trading, for example. So when looking at Admiral Prime, so this is the account I'm using myself. So this is based on personal experiences I made there. It's really terrific to see how tight the spreads are, in addition to a very small commission you pay per lot here. And then, so what I can say is definitely, it's definitely worth visiting admiralmarkets.com, give Admiral and their offering a deeper look. And not only that, by the way, so we will refer to something which is known as Admiral Invest, in fact. So why is this noteworthy? Well, this is something we will see here within the next minutes. First of all, we want to answer the question, what is short selling? So traditional investing focuses, in fact, on the simple approach of buying low and selling high, while the aim of short selling is, in fact, to profit from dropping prices. Okay, so that means what you don't want to do is here, when short selling a stock, you don't want to see the price to rise, but you want to see it dropping, in fact. So while it seems easy to short a derivative on an asset, so for example, a CFD, that's what I said at the beginning of this webinar, shorting physical stocks, so where I mean physical is the real asset. So once you, for example, once you buy a CFD on a stock, you're not receiving dividends, for example. So what is completely different when buying a physical stock. So there you get a dividend. That's, I don't know. Let's have a look at the German example, for example, a Siemens or something like that. So usually you get a dividend when holding the physical, the real stock, the real asset, while when you hold the derivative, the CFD on, in this case, Siemens, for example, you're not receiving such a dividend. So just to make sure that we are talking about, that we're on the same page here, when I refer to physical, I mean the real asset. And so when looking at this, it's a little more complex, in fact, because to short a physical stock, in fact, the trader needs to borrow it from someone who has it, like a bank or a broker, and then sell it with the target to buy it back later. So you borrow the stock, okay, from, let's say, your broker, and you sell it at price 100, for example, 100 euros. And once the price drop, and say it drops to, let's say, 80 euros, you buy it back. So you're selling to someone who wants to buy it, and then you buy it back from this person or from the market in general, whoever is then willing to sell it at 80, and you're buying it back then. And the difference is 20 euros, which means you're then profiting per share in a range from 20 euros. So now the personal anecdote in this context, I think the whole concept to some extent is quite clear, but nevertheless, I think it's noteworthy that even if you do not grasp the concept right now, it's not such a big issue, but I highly recommend sitting down, thinking about it a while, how you can imagine then to borrow the stock and to buy it back at a lower price. Because when I started, when I started in finance in general, so it wasn't really trading related back then. That's something I have to admit. So there was the question when I finished school. That was 2004. So the question was, well, what will I do now? Will I go straight to university, or, and that was what my parents suggested. They said, well, don't you want? Please consider finding something like a traineeship, so to have something. So in Germany, we have a concept where it says that you are a trainee for 2 to 3 years, in fact, with, for example, a bank, and they educate you. And after those 2 to 3 years, you are then a bank clerk. in case of a bank, for example. And this is the common way how you get into the world of working, let's say. So you have to first have a traineeship, 2 to 3 years, and after that you can then start as a real bank clerk in case of banking. So, and the coincidence was that I was back then I was with a bank. That was my bank account, and I wanted to see what I have in my account, which means I had to get a bank statement. And the bank statement, there was a small sentence right at the bottom of the statement saying, well, we are hiring and we are looking for trainees. And that was right after my parents came up with like, yeah, university is nice, but still probably think about finding something solid, let's say, first of all, solid, and that you have something you can fall back on just in case the career in university is not what you were looking for. And so I applied for the job, and it was in fact not only this bank, but there was also another right at this time who was hiring. And yeah, I applied 2 times. I received invitations to the to a job interview, and I received both jobs. That was quite nice. Probably not how it's usually how it's used to be, as I learned then from several friends and relatives. But still, I got lucky and I had 2 job interviews. I got the job, and so I started working in a bank. Now the thing is, I don't want to start with having no knowledge at all what I'm currently looking at. And so I went to my dad and I asked him, hey, do you have any book or something? Can you, any kind of literature I can study before I get started? And as well, the same is true for my dad, but it's also true for me. So when I was thinking about a bank, I was thinking about trading. I was thinking about wealth management. I was thinking about stock exchanges and flashing lights and screaming people in a trading pit. So that was what I considered to be banking, and that was the same for my father. So he handed me a book, and it was a book from Andrei Kostolany. You probably heard about him, one of the biggest investors in our time. And I read the book. And now the funny thing about this is, and this is where short selling comes into play, he's also referring to this concept of short selling. And right at the start, I didn't grasp this concept at all. So to me, it was so abstract. It was so weird that you can borrow a share, sell it, and then buy it back at a lower price, that I really had to think about this. And I by the way, I also got skeptical whether this abstract world of banking is probably the right place for me. And this is probably a very tough statement for someone who has a crush on mathematics, in fact. So I studied mathematics after my career in a bank, or after the traineeship then, after 2 years. That was the time I spent there. So, and this concept was so abstract that and why I tell you the story is, if it's abstract to you, and if you think this is something that doesn't feel not right, but it's not straight understandable, it's not a problem at all. So just think about it a while, and once you grasp the concept, you will get used to this. In fact, what's important here is that you just think about it, borrow the stock, sell it, and then buy it back at a lower price. That's what your aim is when you're short selling stocks, in fact. So now the question which arises then is, and this is probably one of the reasons why some people are probably irritated about this. So once we are trading CFDs, once we're trading FX, as I already mentioned at the beginning, for us, selling short, respectively betting on drop in prices is not such a big thing, because we just push the sell button and then we're short whatever amount, whatever asset. It's not a big issue. So to short the DAX, to short an index, to short, again, WTI, oil, for example, gold, Euro USD, or a share like Amazon or something. Probably not such a good idea to short Amazon right now, but still. This is easy for us as CFD traders, but it's the complete opposite when it comes to physical stocks. And the reasons for that will become clear in a few minutes. But the answer to the question, can everyone short sell physical stocks, is a clear no. So in fact, it's usually, most of the time, it's only available for institutional, professional, and also proven, well-capitalized investors. which means you have to really prove that you fall in a certain, let's call it wealth category, to get this access to selling stocks short. So let's look here then now at Admiral Markets. And Admiral Markets is not only an FX and CFD broker, but it's a true multi-asset broker. So they also offer the opportunity to buy physical stocks, respectively also buy ETFs. And so when you look at this account, which you can find on the website, by the way, under Invest, and it's only available in the MT5, by the way. This is the traditional investing account for stocks and ETFs, as I already said. You will see that, in fact, here at Admiral Markets, when it comes to this Invest account, you will see that's only possible to buy stocks. So if you want to sell, you have to make sure that you have it. If you don't have it, you're not able to short sell it, which is not such a big issue. You have to open another account, and then you can easily short sell. Let's say you have a stock like Amazon, take the example again, and you have the stock physical and the portfolio for whatever reason, and you want to nevertheless hedge your exposure here because you expect, for example, this a corona lockdown which now happened, and the potential risk aversion which is hitting the markets, hit the markets already and will potentially hit the markets again the second half of the year because there's a second wave, for example, but you still don't want to sell your Amazon stock. And by the way, I'm not sure. I think Amazon is not paying a dividend. So probably it makes more sense to look again at Siemens than the German stock. I definitely know that Siemens is paying a dividend. And you don't want to sell it. So just imagine you're a former employee of Siemens, a big German company, and in the market for way over 100 years. And you were an employee and you worked for this company. Let's say you went straight from school to the company. You worked there for 40 years and they paid you for your work, not just a salary, but in addition to that, you also receive the compensation with stocks then. And you don't want to sell these stocks because it's part of your pension fund then, in fact. So you want to retire and still have this stock in your portfolio because it pays a very attractive dividend. And now the thing is, let's say there's such a high volatile market environment as we currently have, and you don't want to sell this stock. So how do you hedge your exposure then? How you limit the down impact such volatility which is currently hitting markets around the corona lockdown and coronavirus in general, and all the fears and panic which pours up. So how can you hedge this? And there CFDs come into play because now you have the possibility to have the portfolio and the physical stock in a long position, but you can hedge it by short the same amount via a CFD, which is, by the way, also very cost efficient. It's something we will look at then. But this is just one concept, one idea behind this. By the way, let me just show you the website and where you can find this here. So it's admiralmarkets.com. And when you want to get to know more about this invest opportunity, just here, check products, the products tab, and there you have Invest MT5. And there you get all the information on that. And you can also, this is important to note here, you can switch between ETFs and also stocks. So here you can see the exchanges we are talking about. So German Xetra, for example, Norway, everything else. And here you have a list, not just advantages and why, but you have also a list then. Let me just see. Okay, you have to click Start Investing first. And there you have a list of stocks you can trade. So this is plenty. It's a lot of stocks which fall here within this invest category. But let's come back now to the presentation. So again, we want to answer the question, can everyone short sell physical stocks? The answer is no. And to give you a better idea of that, it's not only that I give you a reason here, but we are talking about enormous risks when looking at selling physical stocks, in fact, because the thing is that this shorting of physical stocks goes hand in hand with a theoretical risk of losing an infinite amount of money. So you might now say, how can I lose an infinite amount of money? Sure. Therefore, a stock which you sold short needs to rise to infinity, which is, well, just in case of Apple and Amazon, probably a topic, but not any other stuff out there. But the thing is, there are examples which are in the mind of many short sellers, respectively traders, especially those here in Germany. When we look at them as share, Volkswagen here, the big German car producer, in fact. And here we look at the time span, which is probably of high interest, in fact, because you might now say, well, wait, it's October 2008. Wasn't that during the great financial crisis? So potentially, when this guy is talking about enormous risk of losing money, how can it be that he's referring to Volkswagen? Because shorting the stock there usually was very profitable. That was most likely right when looking at especially stocks from the financial sector, but not in case of Volkswagen. There was something which happened. So there's the other big German car producer, Porsche, and Porsche wanted to increase its share of Volkswagen here by another 31.5% via options. So they had the option. So these two companies, Porsche and Volkswagen, they were very well they're tightly connected with each other. So you can, by the way, also see this when looking at the German Volkswagen Käfer. This was the car in the 1950s, or even before that, 1930s, 1940s, I think already. And the first Porsche 911, for example, when looking at the first cars there, you can see both look very, very similar, and there the similarity comes into play. But this is not what we want to talk about here. So Porsche wanted, in October 2008, wanted to increase its share of Volkswagen here by another 31.5% via options. And so here, short sellers, potentially because of the overall outlook, which was very, very dark for the overall economy, the great financial crisis at the horizon, big volatility in financial sector. So there were many short sellers out there betting that Volkswagen shares would drop in price. But they got caught on the wrong foot because they had to cover 12% outstanding volume in Volkswagen short positions. So in fact, short sellers had an exposure of 12% uncovered short positions. So there was no really hedging opportunity, or there was not enough supply when it came to Volkswagen shares here. In fact, it was that there was only 6% of shares freely traded, which means you have to cover this 12% outstanding volume in short positions here, and you have to cover it by only 6% of shares which are freely traded. Now that resulted in a massive squeeze within this time span from the 26th to the 28th of October 2008, from nearly 210 euros up to 1,000 euros in a few days, in 3 days, in fact. So yeah, I have the picture here. So the announcement from Porsche here triggered this massive short squeeze. And now let's assume the following. Let's just assume you're here and let's say you shorted 500 shares from. Yeah, 500 is probably, yeah, let's make it 500. So it's 500 stocks you sold short at 200, let's say 200. Okay, that makes things way easier. So, which means you have now an exposure of 100,000, and then you see the market squeezing up to 1,000, which brings your whole position to a minus 500 shares multiplied with 1,000, which brings your position size to minus 400,000 euros within one trade here with this squeeze. And again, you are not finding anyone who's willing to take your position, because if you're short, you want to buy. Everyone wanted to buy. So there's no one willing to sell here in this regard, so that you can cover your position, which results then in this massive squeeze. So this is the perfect example. It's not happening very, very often, but if it happens, and if you get to see such a squeeze, even in such a big company like Volkswagen and the blue chip, then it can get really, really ugly, in fact. And this squeeze is the perfect example of why selling short stocks is not available for all investors, in fact, because to cover this position here, if you got a margin call, you're forced to cover this position. So it's not that you're, and this is something we will look at when looking at CFDs. You probably remember the ESMA decision in 2018, when there was one thing announced when it came to CFD and FX brokers, that you're, it's not only a leverage restriction you're right now facing as a retail client, but there's also now, there's no chance that your account, once you have a retail account, once you're registered as a retail client with your FX CFD broker, there's no chance that your account can go to negative territory. That's complete opposite here when looking at selling physical or short selling physical stocks. The same when looking, for example, at futures. The future market is the same. So there is this not just margin call procedure, but there's also then the what's the word for this? In Germany, it's Verpflichtung. So you have to cover this position. So there is this option that your account can go negative, in fact. And this is what I was talking about here at the slide before, when I said you have to prove that you're well capitalized, because not every trader is. Respectively, it's not probably only that you're well capitalized, but in addition to that, you also have to prove that you that someone can say, or the broker can trust you, that you know what you're doing, so that you're really a professional client, someone who has a load of experience trading the markets. In fact, if this is not the case, one or the other, usually it's both, you won't get access to short selling physical stocks, in fact. So, and now we want to compare short selling physical stocks and want to compare this to CFDs. And I prepared the following table here. So we made this a topic now already. So potential loss is theoretically infinite when it comes to physical stocks. When looking at CFDs and when looking at retail accounts, what we want to do here with limited access to leverage, but also with no chance that your account can go negative. When it comes to CFD short selling, then for retail traders, it's limited to their account size, respectively the deposit. This comes back to the duty to deliver shares, in fact. So when you look at physical stocks, then yes, in case of short selling, you have a duty to deliver the shares. That's what I just referred to. So it's not possible. Your account can go negative here, respectively. You have to buy whatever price then is offered at the market, and you have to deliver the shares, which is not the case when looking at CFDs. So this is, since CFDs, I mean, CFD means contract for difference. So you're only betting on the difference between prices, in fact. And that means that these are 100% cash settled. So there's no need to physical deliver, which is, by the way, also important to note. And that's now probably make a short look at what happened in WTI oil prices, for example. Same thing. So you've probably heard about oil prices getting negative. That was on the 20th of April. With lots of volatility also right now in the markets and potential dysfunctionality in markets in general. So the question was certainly, why was this an issue when it came, or how could it happen, respectively? What was the advantage when you trade CFDs compared to, was not good. Well, what's the advantage then to trade CFDs compared to the future? So in this case, the WTI future. So what happened was that there was an enormous long exposure here when it came to a WTI futures, which were expiring on this exact date, respectively. We are talking about the May contract, in fact. So what the future says is, if you hold the position over the expiration date, okay, and if you do not roll it over into the next contract month, which has to take place, or should take place already, probably a week before, especially when it comes to retail trading. But if this is not the case, you have to take, in this case, the delivery of oil barrels. So you have to take oil in physical form. Okay, so they deliver barrels. So we're looking at one WTI crude oil future contract, and we look at one lot. This means that you have to take delivery of 1,000 barrels. So you probably have to have a quite big swimming pool to take 1,000 barrels in oil. Okay. So now the thing is that around the developments during the last months, in fact, and the oil price war, which became a big issue right at the beginning of March, for example, when OPEC Plus went bust. Let's say once Russia said they're not willing to cut their oil production. So that resulted in Saudi Arabia going all in to remain liquid, in fact, because they have to finance their whole infrastructure in Saudi Arabia by selling oil. And if no one really wants to take the oil, you try to make everything liquid in case of cash to keep on financing your whole structure, what's possible. That's why they offered a discount. So they pushed WTI into the markets. To make a long thing short, the thing is, we're talking about the physical, instrument. So which means there will be a time once you don't have storage possible, or the storage capabilities, you're running out of storage capacity. And now the thing is that no one really wanted to take delivery of physical oil because they had no such chance to store. Probably they haven't even booked it in Cushing. We're talking about WTI crude oil, which we're talking about here, Cushing, Oklahoma. Then they haven't booked any storage. Respectively, they had no chance to take the physical delivery. And so it was like throwing around a hot potato, let's say, and no one really wanted to take the spot price or the WTI contract beyond the expiration date to take delivery here. And that's why what happened then was that they were willing to say, you know what, there it is, it's a present, this is your contract, and in addition to that, I pay you, let's say $40, for example. This is how prices went negative. Long thing short, this is what happens when you look at physical markets. You have to remember, we're looking at a chart here, we're looking at a complete abstract product, in fact. So when trading paper oil or stocks here only on our screen for speculative purposes, well, we are still trading in a real world, and you have to make sure that you understand that. So which means then that here it could be that you have a delivery to duty to deliver, respectively, take the delivery, in fact. If you do not have space in case of oil, for example, well, things could get ugly, in fact. When looking at CFDs, there's a big advantage when looking at CFDs. We're looking at a 100% cash settled product. So this is not what happens here. If you were long beyond expiration of this June or May contract, I'm sorry, well, you probably have faced a loss, but it was cash settled and it was limited to your account size, and you couldn't go negative with your account balance here, in fact. So this is something where the advantages of CFDs become obvious, very obvious, in fact. And right now, during this quite volatile time, it becomes probably even more obvious why considering CFDs as a trading product is something definitely worth considering, even if you're probably only investing long term. You're watching this video now and say, well, it's CFDs, I'm not interested in CFDs. Sometimes it might make sense, especially when it comes to hedge your exposure, respectively, when you want to avoid, for example, such squeeze movements like, especially when shorting markets, CFDs are way easier to access then. While it's not available for everyone in physical stocks, it's also very important then to find a way to hedge your portfolio then. So, and then we come also to the cost aspect here. So when looking at physical stocks, you shouldn't underestimate that it's very, very expensive, in fact. So you have to borrow the stock, you have to pay for this, so the bank won't give the share to you for free. And it, in fact, depends on the availability of shares. So which means some of you might now say, well, what a great trading idea. Look at this squeeze here. I will short stocks here right at the top and make a fortune on the way lower. Well, it's a quite great idea. The only problem is that if you got a chance that someone will borrow shares to you here, it would have been quite expensive because it depends on the availability of the shares, which is not necessarily given in such an environment as I described here, in fact. And when looking at CFDs, well, we are looking at a pure abstract product here, in fact. And it's comparable to other asset classes, indices, commodities, FX. The costs, the so-called swap prices, which play a role, yes, but nevertheless, compared to physical stocks and short selling physical stocks, it's quite inexpensive. In fact, depends. Certainly, it depends, but nevertheless. So, to roughly speaking, you can say one is quite expensive, physical stocks, while the other is not just available for many, even retail traders, but it's also compared to physical stocks from a cost perspective, it's quite cheap, let's say, certainly depending on the context, but nevertheless. So let's have now a look here at the advantages and risks, and let's have a look at the advantages first. So when looking at short selling, it increases the toolbox of available assets here in regards to also to be able to profit from different market environments massively. So it's not only important from a purely speculative standpoint, but also in terms of hedging existing portfolios. Again, just imagine you're an employee, you have stocks that was part of your compensation, it's part of your retirement plan, and you generate an attractive cash flow based on the dividends which are paid. Now, the thing is, you don't want to sell these stocks at no cost, because this would interrupt, respectively, would result in not having a cash flow anymore, which means if you want to short sell your portfolio, then CFDs come into play here, and you can find a quite easy and cost-efficient way to keep your physical position, to keep this cash flow, to have this let's call it dividend flow, while you can also make sure that you are not losing an enormous amount of money once prices of the physical stock drop, but you profit, and that means you're losing the physical environment, but you're profiting from the share you sold short via CFD, for example. And so you hedge a certain price level, which you could probably, after the price drop is then done, you can also use the money you received here to buy probably stocks in the same name, and add it to your overall portfolio, probably extend also your cash flow then from a dividend perspective, just to give you one idea how this could play out then. And as I already said, from an advantage perspective, CFDs, when looking at short selling stocks via CFD, this is usually a very cost efficient and effective way of trading, respectively hedging. Still, there are risks connected to that. So while when looking at physical stocks, you have an infinite risk of losing money, and you do not have this risk when looking at CFDs and short selling. There's still a risk, because when we look at the CFD, you're usually working with a leverage here, which means that adequate and disciplined risk and money management is still inevitable when shorting stocks also from a CFD perspective. And that probably became especially true when looking at the recent developments. So I've prepared the Admiral markets MT5 here, and this is the MT5 trading environment. So we're not looking at the invest account. Could have opened that too, but I think it makes more sense when looking at CFDs here to have the trading platform open them. And so just assume that we're looking here at Amazon. Usually it's not a very good idea to short sell a stock like Amazon in the current environment. Just imagine what happened to short sellers here who weren't convinced that this bounce is sustainable, which happened. Well, while other stocks are still suffering, Amazon is one of the big profiteers here within this market environment, and pushing to new all-time highs, and still pushing to new all-time highs. And there are probably reasons to that. For information, check out the Traders blog section. There's also an article on what could be the potential driver for Amazon. But let's come back to short selling. Just imagine you had an idea, you had a feeling that probably there will be a sharper bounce here, and you shorted Amazon for whatever reason in this region here. So now the thing is, you probably have profited from the drop which happened here. But if you did this with an inadequate position size, so it's a very, very optimistic scenario within, you definitely made money on the trade. So please don't take this as a granted example when shorting stocks that you make money. That's definitely not the case. But I want to illustrate this here. So when looking at this price, so it's around 2,150 USD. You shorted the stock for whatever reason here within this. And now you see the price drop, and there's now push of something like 500 USD per share. You see the drop here. So the drop is around 25%. Now, you probably have wondered whether you could have held the trade. Let's assume that was possible. That it was possible to hold the trade here from 2,100 till the lows here and open the position here and close the position there. Is this a realistic example? I think it depends, because if you use an inadequate leverage, it is quite possible, I'd say, that after the initial drop here and the bounce, this probably made you already nervous, especially when looking here at this orange line. This is the SMA 200, the simple moving average, which is very, very important from a trend perspective. So long-term trend perspective. And probably you've seen that here. And the inadequate leverage probably forced you out of the position, because the bounce here of, in this case, 200. Let's say this is 200 USD. Okay. So let's assume you have one share and you are working with a leverage of, it's not 20 to 1. No, it's 20 to 1. It's 20 to 1. It's not 10 to 1, but it's 20 to 1 in this case. So this means that here in this case, 200 USD multiplied with a factor of 20, we're already talking about a bounce of 4,000 US dollar. While when working, for example, with a leverage of only 5 to 1, this bounce of 200 is 1,000 US dollar. So which means you're more likely to keep the position open once you work with a smaller, lower leverage than trading with a too aggressive leverage. So position size is also a big, big topic when looking at physical stocks in this case, not physical stocks, but shorting stocks via CFDs too, which means even if you do not have a risk of an infinite amount of losing money, still a very disciplined risk money management plan is inevitable for the long-term success. And the risk is also here. The delivery risk is not given when trading CFDs, but the thing is that knowing about the dynamics in the background can be helpful in regards to potential dysfunctionalities in underlying markets. There's also something, it could result, what I'm talking about here is the following. So, and therefore probably it makes more sense to have a look at gold here in this case. So probably I've seen of the month of March that the spread widened, meaning widening spreads when looking at gold here. So, and right now you have a market environment in which, well, by the way, let me just do the following. You can also show the spread here. Where do you have it? Isn't it here? Oh, 1 second. I'm probably view here, toolbars. I know that the tab is there, but where is it? Depth of market is not in search. Okay, it's not important. Never mind. So I have to look it up. Usually there should be a spread. Probably however. So you can usually display the spread here. However, the thing is, so what you can see here is that the spread right now is something like 50 cents. Yeah, close to it. So it's flexible because there's the liquidity provider is using the best bid, best ask here. So, but still, during March, you could have seen the spread widening here to sometimes $5. And why was that? What was because the physical market and the paper market got disconnected. So while we had margin calls who were triggered in, let's say, equities, and therefore market participants started to dump their gold holdings in paper. There was still a quite high demand when it came to physical gold here, and that resulted in a dysfunctionality in the market with this spread, we call it the base between the spot and the paper market disconnecting, and thus the spread to widen dramatically, in fact. And this is what I'm referring to when you're trading CFDs, it could mean that you face such issues from dysfunctionalities in the physical market in your CFD positions. And this is something you have to remember yourself all the time, and be aware of that. This is an advantage, in fact, because it makes sure that you really grasp the concept of what's going on behind the scenes and you really understand the product. Still, it could be also a risk in your trading and something worth remembering, I think. So let's have a look here at the summary. So short selling gives traders a very important tool to profit from both rising and falling markets. And CFD short selling is also available for retail traders, which is not the case once you look at physical stocks for the explained reasons. The advantages of short selling with CFDs are that it's very cost efficient. It's a very cost efficient way to sell or short all asset classes. It's not just stocks, but we're also talking about indices, commodities, Forex, for example, and you avoid the risk of infinite losses once you talk about retail accounts, or once you register as a retail client. And still, successful short selling requires experience and a very strict and disciplined risk and money management approach and a trading plan in general, something which you have to make sure you have. Which will grant the long-term success. If you don't have a plan, it doesn't matter whether you have this tool of short selling within your trading toolbox or not. It's unlikely that it will succeed. So it needs a definite trading plan, a positive expectancy within your trading plan, and also risk and money management strategy, which is professional, in fact. So Monday, same time, Paul will talk here about the MACD. So moving average convergence divergence. That's the long version of it. He will answer the question, what is the MACD? He will answer the question of how do most people trade using the MACD, and what's the smarter way to trade using the MACD. Same time, Monday, 4th of May 2020, 2 p.m. London. And once you're here now in the live event, then you can check your inbox. You will get the link to the webinar directly forwarded to your inbox links, to your inbox link. You will get the link to your inbox. Sorry. And if you watch this now on YouTube, you can head over to admiralmarkets.com and there check out the education webinars tab. And there you can register for free for the Trading Spotlight webinar. And admiralmarkets.com. This is definitely worth watching regarding research, but also the invest product and everything, admiralmarkets.com. Any questions which may arise, you can contact Admiral Markets directly via these channels here. And this is the risk disclaimer. So have a nice weekend. Enjoy yourself. Talk to you again next week on Friday. I look forward to it. See you. And